I did a video a few days ago on the channel called 6 Stocks I'm Buying Now, February 2025 edition. And in that video, I mentioned a specific stock named Wynn Resorts, right? That was stock number 6 of those 6 stocks we talked about in that video. And I, spoke about why I think it's a great opportunity and whatnot. Well, they reported earnings and the stock is definitely spiking on those earnings that they did end up reporting. So, what's interesting here with Wynn, you look at the Wynn Palace. This is their premier property. This is their big daddy. This is the granddaddy of them all on the Cotai Strip in Macau. They did $562 million of revenue in the fourth quarter. That was an increase of almost $40 million on a year-over-year basis. So very strong number there. Wynn Macau, the older properties, that would be these guys right here. Those properties decreased about $22 million, but the Las Vegas operations, which is these properties, this was shocking. I'm shocked. Somehow the company increased revenue $2.7 million. I don't know how the heck they pulled that rabbit out of the hat, because this was a year where they had a comp against the insane F1 comps. Now, F1 was in Vegas again this year, but the previous year was the crazy year in regards to F1, where people were just paying like ridiculous room rates, where everybody wanted to come for the F1 race, first time in Vegas. And so the fact that they somehow grew revenue, I was pretty shocked at that. Now, Encore Boston Harbor, a little bit tougher place. They decreased revenue $4.5 million in Encore Boston Harbor. And then as far as their property they're developing in the Middle East right now, they're still talking about that it's supposed to open in 2027. With how fast it's going up, I'm surprised they're not going to open in 2026, just to be quite frank with you guys. Now, as far as earnings per share, non-GAAP EPS, they did $2.42. That beat by $1.15. Insane beat by Wynn there. They also beat on revenue as well. Additionally, they announced they're going to pay a 25-cent dividend payable to shareholders on March 5th, who are shareholders by February 24th. So do keep that in mind, which I'm looking forward to receiving dividend money there, right? Now, additionally, they got asked on the conference call about what they're going to plan on doing with the land they own in Las Vegas. And Craig Billings, CEO, he said, we obviously have a very substantial land bank here in Vegas. We have years and years and years of growth ahead of us. I often get asked, why aren't we moving on the land in Las Vegas right now? And the reality is, from a capital perspective, from a bandwidth perspective, within our amazing design and development teams, there's so many other things, frankly, there's only so many things we can do at once, essentially, right? Which they got that property they're building in the Middle East right now. Additionally, they're still trying to get that deal in New York City, which, I'm almost kind of hoping it doesn't work out in regards to that. And then they're investigating if, it makes sense to potentially build a property in Thailand. So do keep that in mind as well. Now, in regards to the Las Vegas Strip land, it's very important everybody understands this. This is a Las Vegas Strip here, the green there. And Center Strip would kind of be around like Caesar's Palace in Bellagio area. That's kind of always considered like Center Strip. And then down here, you kind of have the south end of the strip, and this is the north end of the strip. So the Wynn's more toward the north end. But Wynn owns literally pretty much the only piece of dirt that's on the premier part of the strip you want to be. They own the dirt that's right across from Wynn and Encore, which everything else is already developed. So that piece of land there is extremely valuable. I mean, extremely valuable, because you don't have to worry about, knocking a building down or anything like that. It's just pure dirt. It's ready to be built and start to be developed, right? And so it's a very valuable piece of dirt. I can tell you that much. And so the question is, do they ever sell it? Do they develop it? I don't know. I wouldn't mind them selling it off, because they could probably sell it for a big number. I wouldn't be surprised if they could get $1 to $2 billion for that piece of dirt, honestly. That wouldn't be shocking at all. I heard what they're trying to sell Circus for. So I'm like, if they're trying to sell Circus for that, the dirt straight across from Wynn and Encore, oh my gosh. And so, yeah, but my thing is they probably want it to be a very specific project. So I don't know. We'll see what they end up doing with that, right? Now, additionally, you got to keep this in mind in regards to Wynn. If they ever want to sell off their 2 properties and essentially do what a lot of other resort properties have done on the strip, they could do that, where essentially they could sell these properties, probably fetch maybe $6 to $10 billion for those properties, and then they basically kind of like lease them back, so they pay like rent to whoever actually will then own the buildings. And so it still stays Wynn and Encore operated, still all their branding and things like that. But essentially, Wynn would then get that massive cash pile, which then if they want to pay off debt, they could do with that. If they want to use the money for other developments, they could do that, right? And then Wynn would essentially pay rent on a monthly basis or an every 3-month basis to whoever actually owns a property. My guess is they haven't done that yet, because I think they're still using a lot of depreciation on the properties. So I think that's one factor. And then the other factor I'm thinking in regards to this whole Wynn and Encore and why haven't they sold it and why they want to keep ownership. Maybe it also has to do something with what if they want to do renovations, you know, and how all that would work. What if something goes wrong? Like, I think there's kind of some issues in regards to that. But the moral of the story is, if they ever want to do that, $6 to $10 billion is out there for them to generate just like that, right? And still be able to operate the property in itself. Additionally, they own this massive golf course right behind the property, and that's a very valuable piece of real estate. It's not as valuable because it's not technically on the strip like the dirt is they have across. But the golf course, my guess is they could, if they ever wanted to sell that off, they could honestly probably sell it off for easily $300 to $700 million. And I might be conservative on that. Remember, that piece of golf course is right by the Sphere right there, right? Obviously, right behind Wynn and Encore, you got Palazzo Venetian right there. You got the convention center right over here. So, you know, I'm just saying they got a lot of opportunities with this company to generate substantial amounts of cash if they want to keep developing or whatever they want to do here, pay down debt, stuff like that. Now, looking at the income statement here, I gave them a C+ grade. Operating revenues were around flattish, roughly on a year-over-year basis, right? But operating income went to $366 million from $357. Now, last year they had this massive one-off benefit here. This is, benefit from income taxes. That's $499 million one-off. So this year, only $41 million. So that kind of hurt their net income, but it's not nearly as bad as it looks, obviously, because we're talking about, that's what, a $458 million benefit there. It's insane. So moral of the story is Wynn's looking really darn good, and always keep in mind Wynn's always a buy under $100. The further it goes under $100, the more it's like a strong buy. So if you can get it under 80, now we're really talking. If you ever get under 60, count your blessing, because that very rarely happens, and so that's very fortunate there. Okay, so that's Wynn looking real good for the long term. Great company. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Winning Resorts up only 4% on Wynn Resorts as of right now. This one's a great opportunity. I spoke about Wynn Resorts pretty extensively, I think, on the main channel, Financial Education. I think I spoke about that extensively on, it was either Thursday or Friday. I think it was on Friday's video. So if you want to hear me talk a lot about Wynn, check out that main channel video from Friday. AMD. Down 7% on the stock right now in the portfolio. And I'm like, thank you very much. Oh my gosh, like I'm just going to continue to buy AMD. Like you'll probably see me buy AMD every week for the next several months. I'm not kidding. Like you will likely see me buy shares of AMD probably every single week for the next several months. Because here's the thing, I'm down in the position right now, 7%. So I love to, I already thought it was a great deal when it was 7% higher than it is now. So now it's even a better deal, right? But here's the thing. When AMD starts to go up, and once I turn green in this position, and then let's say I'm plus 7%, you think I'm going to stop buying? Probably not, because it's still going to be a great deal once I'm plus 7%, right? So AMD needs to appreciate probably 40 to 50% to make me to slow down my buys. So that means that AMD I'm not done buying the stock anytime soon. Like this is still a steal deal buy for me in my personal opinion, right? And when it comes to AMD, the valuation is very darn attractive. Forward P in the 20s, come on, man. Like with how much growth AMD has over the next many years, to be trading at a forward P in the 20s right now, come on. Like people don't quite understand everything that's going on with AMD, and I'm thankful for that. I am very thankful for that. SoFi, and AMD is another one. I speak about AMD a lot recently, even on the reaction channel here, but definitely on the main channel as well. SoFi is doing its thing, now up 47% on the stock in the portfolio. I wish I had more shares of SoFi. That's the thing with SoFi. I keep wishing I had more shares in the public account and wishing I had more shares in this portfolio as well. SoFi's still a good deal. Like, that's the thing. Like, SoFi, yes, it's gone up, I know, a lot over the past 6 months. It's still a good deal, I think, for long-term investors. Because remember, a bet on SoFi is a bet that SoFi is going to become a financial giant. Financial giants are $100 billion plus market caps, or several $100 billion market caps. And so if you believe SoFi is going to become a financial giant over the next decade, right? So let's say between 2025 and 2035, you think over this next 10 years, SoFi is going to emerge as a financial giant. Then we're talking about $100 billion plus market cap on this one. So if they can execute on that, they never go BK in the next big recession or anything like that, and they're able to, Anthony Noto's able to keep the company always in a good capital position, coming out of those recessions, they're able to dominate. Like, you'll see the stock become a financial giant, and you'll see them become $100 billion plus market cap, and that's going to be a whole lot of fun in regards to that one, because you'll have gotten to see a whole process of like SoFi from like a baby financial institution into like becoming a financial giant, right? And you look at the numbers, you look at the members they're attracting, you look at the most recent quarterly numbers, and you can put the pieces together, and you're like, dang, man, like they're on their way to becoming a financial giant. Like, they still got a lot of work to do. But the groundwork is all laid at this point in time, right? If we're building a house, I would say SoFi's already got the foundation of the house done, right? And I would say they've even got the walls all up, right? They even got the roof on. Like, now SoFi just needs to get the interior of the house finished, and I mean, I think we're looking really good in regards to SoFi. Amazing's on. This is a position we're up about 81% on. There's another one I wish I built it out more aggressively back in 2023. I was a little too slow with my buys. But the thing was, when I started this portfolio, man, a lot of those big techs were still really, really cheap. And so I was trying to buy Meta, I was trying to buy Amazon, I was trying to buy Tesla. It was just, there was a lot of opportunities at that particular time. Revolve, and by the way, in regards to Amazon's valuation on this baby, we can go ahead and take a peek at that. So Amazon trading around a 35 forward P, very fair. And remember, Amazon comes in and beats numbers quite often. Very fair valuation for Amazon. This is a company that you can count on just growing and growing and growing. They put expectations very low going into this year too. Like, if you look at their latest guidance, they're talking about 5 to 9% revenue growth. I can't imagine Amazon growing less than 10%. I can't imagine Amazon growing less than 10% a year, any year in this entire decade, all the way out to 2030. Maybe 2030 through 2040, maybe we start talking about growth rates a little slower. Maybe we talk about, revenue growth of, 5 to 9% then, but it's just really hard for me to wrap my head around anything less than 10% revenue growth. And because they have three main growth businesses: e-commerce is growth, Amazon Web Services is growth, and their advertising business is growth. So for me to imagine them not growing at least 10%, no. This company set expectations on the floor. Management set expectations so low that this stock is primed to hit 300 plus this year. Like, if we're at this time next year and Amazon's, $310 or $320, I wouldn't be surprised at all. Because of how low management set expectations, then now they should come in and beat numbers throughout the year, and everybody's going to flip their flapjacks over this one. But just phenomenal growth, obviously, in regards to this company, year after year after year. And, obviously the margin story's gotten a lot better over the last couple of years here, from negative net margins to now we're talking about net margins of around, getting close to 11%. That's got a long way to play out. Net margins for this company long term, I think they're probably more in the 15 to 20% range. AWS, great profitable business. Advertising, we know that's straight profit. That's, Amazon's name of the game. But the e-commerce side of the business, I think they're going to be able to focus so much more on profitability, in my opinion, over this next decade in regards to e-com. Bezos and the team really just wanted to focus on making sure they won the opportunity, because that's a multi-trillion-dollar opportunity itself. Like, e-commerce alone, we're not talking about AWS, which is arguably just as big of an opportunity, if not bigger, for the company. But e-commerce is a multi-trillion-dollar opportunity, right? Like, that's so big. And so I think Bezos and the team has always focused that business on, let's just make sure we're number one by a mile. And they have. And they won. The game's over now. So Amazon won the next 10 to 20 years in regards to e-commerce. So now the name of the game, in my opinion, is really focusing on profitability over this next 10 to 20 years. That's my opinion on that, right? So these net margins, this is still very early days. When you see Amazon at a 10% net margin, just understand we're likely going to 15 to 20% long term, which, we're talking about a company that is eventually going to be doing $1 trillion of revenue. So when we're talking about $1 trillion of revenue, and we're talking about a 20% net margin that they'll probably be at long term, in my opinion, we're talking about a company that is going to have net income of $200 billion a year. That's crazy. And they'll still be growing likely. So $200 billion in net income, if you put a 30, PE ratio on that, right? Which if they're still a strong growing company at that time, like they're going to command a 30 PE, no problem, right? Plus they'll be seen as like just a, kind of an Apple-like company and just their dominance. 30 PE on $200 billion in net income, you're at a $6 billion market cap. Now factor in the incredible amount of share buybacks they'll likely do over this next 10, 15 years. And what do you think EPS is going to be? Like, oh my gosh, earnings per share is going to be ridiculous. And so Amazon, it continues to be a core holding in the public account. I wish I held a lot more shares. I wish I held so many more shares in the public account, honestly. But that one's just, they won. They won the next 10 to 20 years between their advertising business, between AWS, and between their e-commerce side. They won the next 10 to 20 years. We have Revolve as a decent sized position in the portfolio, $1,500 there with Revolve. Revolve is kind of, I don't talk about this one a lot. E-commerce company, really focused on clothing, big with the females. Incredible co-CEOs of this company. They run the ship very good. They just do a hell of a job, man. There's just a really good management team at this company. So I like to hold that one. It's just a good company. They usually surprise the upside. Meta, there's a reason Meta is the biggest position in the public account, right? With that being said, it's gone up so much, I can't ever afford to buy Meta shares. Because here's the thing, I only deposit $250 a week into the portfolio, right? And Meta shares are like 700 plus now, because it's gone up so much. So unfortunately, I can't, even if I wanted to buy Meta, I can't buy Meta. I could look into maybe doing fractional shares or something like that, but a little frustrating in regards to that. So, and Meta's still a buy. Like, it's the craziest thing, man. Meta's still a buy. Like, when you factor in the growth rates this company has, and when you factor in, Meta's still a company that's going to be growing 15, 20% for a long time to go in the future, right? And we're trading at a forward P in the 20s. So people make a big deal about, oh, Meta's gone up like 20-something days in a row. It's like, why shouldn't it? Why shouldn't people still be buying Meta? Give me one reason. You don't have one. A company grows revenue 15, 20% in future years. It'll probably grow earnings per share. I wouldn't be surprised even faster than that, right? And then they're investing all this into AI, into the metaverse, all these other great long-term growth opportunities. Like, Meta's a double-digit grower for, who knows, maybe 10, 20 years to go in the future. And so, at a forward P at 28, you're still getting good pricing on the stock. Like, is it what it was when it was $100? No. But even at 700, you're still not getting bad pricing. If Meta was trading at 100 forward PE right now, I'd say, not that good of an opportunity. If it was trading at 50 forward PE right now, I'd be like, not that good of an opportunity right now. At a 20-something forward PE, come on, it's still a deal. And so sometimes I'm tempted to sell those shares in this portfolio, but then I look at the valuation, I'm like, it's so hard for me to sell Meta. It's so hard. Elf on a shelf. Next one, this is a fairly new position, already up almost 10% on it. Kind of upset about that. I'm hoping this one weakens. But the problem is, I think so many people see Elf down and out the way the stock price is right now, and they understand the growth rates this company has. It's been it's arguably the most well-run company of the past 5 years in the stock market. The only one you could put the only company you put in the same sentence as Elf is Nvidia, and that's it. They're the most well-run company of the past 5 years in the stock market, other than maybe Nvidia, right? But this one, the valuation's gotten so compelling on this company now, and Elf's growth rates are just beautiful. It's just beautiful, right? Now, analysts have this whole slowing of growth and then kind of a troughing and coming back up. We'll see. Like, Elf's got so much international opportunity over this next several years. It's ridiculous, right? And they're still growing a lot in the United States. And then when you're looking at operating income, when you're looking at operating cash flow, when you're looking at free cash flow, I think you're going to see a massive bounce back in all those metrics over this next 1 to 2 years. And as all those metrics bounce back strong over this next 1 to 2 years, what do you think is going to happen to the stock price? So the moral of the story is I would love to buy some more ELF. Alrighty, so what do I think about this gentleman's top 4 investments? So first one is basically just kind of like an index fund on the S&P 500. He's talking about SPY, he's talking about VU. You know, I think those are fine, right? Here's my opinion on like the S&P 500 index funds. It's bare minimum activity. It's like if somebody said, "Hey, I want to go I want bare minimum of what I got to do each week." You know, somebody would probably tell them, "Go walk on the treadmill for 30 minutes 3 times a week," right? Bare minimum, like at least do that. That's kind of how I feel about S&P 500 index funds. Like bare minimum, if somebody doesn't want to put in the work and they don't want to actually go run and they actually don't want to lift weights and, do Pilates class and do yoga class and all that stuff, okay. At least go walk on the treadmill a few times. That's the same way I feel about index funds. Like if somebody doesn't want to individually stock pick and they don't want to, actually do the research work on these companies and they don't want to use 1000X, they don't want to say, you know what, let me do some research on this company I heard. This company NVIDIA I looked into. Let me see what's going on with them, right? And they type in NVIDIA's ticker symbol and they see what's going on with the growth rates of this company, right? And they see, okay, the gross margins are going here, the net margins are going here. Okay, here's where the EPS is going. Here's where it's projected to go, right? Okay, here's a free cash flow, okay. And they're doing all this research work, and then they're like, oh, let me listen to the latest conference call of NVIDIA. So they type in NVIDIA's ticker symbol. Not everybody wants to do this, right? And they're like, okay, boom, let me hit the play button. Okay, let me listen to what they got to say. Ooh, I like this. Ooh, Jensen just said this. Oh, right? Okay. Some people don't want to do that, and it's fine. Like you don't want to do that, and you don't want to run your projections. You don't want to say, okay, let me type in NVIDIA's ticker symbol here. Now I've done my research on it. Let me, I think they could grow 30%, blah blah blah, and they put in all their valuations, right? And they say, okay, a P ratio I think 25 to 35 is fair, right? And they run their base case and not everybody wants to do that. And so for the people that don't want to do that, right? There's index funds for you. Just like not everybody wants to actually work hard at the gym, right? So this is not meant for everybody. What I do is not meant for everybody, right? If it was meant for everybody, everybody would have a big house, wouldn't they? Everybody would have a Ferrari and a Lamborghini, wouldn't they? Right? Like just think about it. Like if this was for everybody, everybody would have this stuff. Everybody would be going on baller vacations, right? Like everybody would be traveling the world. Everybody would have the best healthcare, but they don't. And so if you're looking for bare minimum, S&P 500 index funds, always right there. That's your walking on a treadmill for 30 minutes a week or whatever, right? Next one up here, investment number 2, he talks about many investors, the SCHD, kind of a dividend equity ETF. He's talking about here. He also talks about Brookfield Asset Management. Those are okay, but I would just much rather pick, like if I'm trying, you guys know my strategy, GVD, growth value dividends. If I'm trying to do if I want to say I need to buy 5 dividend stocks, let's say I have a portfolio of 15 stocks, right? And I have 5 growth stocks and 5 more just values that aren't paying a dividend, and I'm saying I need 5 dividend payers as well. I'd rather just pick the top tier best companies I can find that have great growth rates for the next several years, likely expected, pay great dividends, have a lower payout ratio that are going to have tons of room to expand that dividend over the next 5-10 years. I would much rather just invest in those top 5 companies than worry about trying to spread my money amongst, because you got to understand there's so many bad dividend stocks out there. So when you just throw your money at SCHD or any of these other ones that are just kind of investing around, just throwing money at dividend stock, you're going to be in so many crap quality ones. Why not pick 5 top tier ones? Or if you want to build a portfolio of 10 dividend stock, why not pick 10 great dividend companies that have immense room to up their dividends in future years, right? And are likely going to get you great capital appreciation along with dividends. Why not do that? Why do I need to hold 100 different dividend stocks, or 200, or 300, or 400, or 500? I don't want to hold 500 dividend stocks. I'm sorry. There's just going to be too many bad quality in there, right? Much rather do my own research and find my top tier dividend stocks. Investment number 3. Okay, there are many options for this one. One could be diversified bond, like the Vanguard Total Bond Fund Index, but its 3.67% yield is relatively low. High yield bonds are crap, man. Bonds are so crap. Look at this. Look at the bond, index versus, let's say, the public count over the past year. And then you pull up a lot of these bond-related indexes over the past 5 years. Oh my gosh, like over the past 5 years, some of these bond indexes are negative, folks. Negative. So, nah. I'm good. Thank you very much. No. Next one, talking about gold, basically. Gold is an investment, GLD. Not bad. Gold's something people could hold as a small portfolio allocation, right? Also, kind of some of the younger folks might just want to hold Bitcoin. You could always do a strategy. Let's say you want to allocate 10% to non-stocks. You could always do something like just put 5% of your money in Bitcoin, put 5% in gold, something like that. I like silver more than gold, but with that being said, that one's okay. It's not my favorite, certainly, but it's okay.